If you've ever had the conversation about whether buying a house is better than renting, you've probably heard someone say this. Renting is throwing money away. You're just paying someone else's mortgage. You'll never build wealth if you don't own property. This advice sounds logical. It feels true. And for many people, it's completely wrong. Today I'm going to show you the real math behind buying versus renting. Not the emotional arguments, not the cultural assumptions, the actual numbers that determine which option builds more wealth over time. And here's what you'll discover. Buying a house is not always better than renting. Sometimes renting is the smarter financial choice. It depends on your specific numbers, your situation, and your timeline. Let's start by breaking down what actually happens when you buy a house. Most people think buying a house means you're building equity while renters are throwing money away. But that's not how it works. When you buy a house, here's what you're actually paying for. First, the mortgage payment. Only part of this is building equity. In the early years, most of your payment is interest going to the bank, not equity you keep. Second, property taxes. This is money that disappears every year. You never get it back. It's not building equity. Third, insurance, required for any mortgage, money that disappears. Fourth, maintenance and repairs. Roofs wear out, HVAC systems break, plumbing leaks. The rule of thumb is 1 to 2% of your home's value per year. On a $300,000 house, that's $3,000 to $6,000 per year. Fifth, HOA fees if you have them. Sixth, the opportunity cost of your down payment. If you put $60,000 down on a house, that's $60,000 you can't invest elsewhere. That money could have been growing in the stock market. Let me show you a real example. You buy a $300,000 house. 20% down payment, $60,000. Loan amount, $240,000 at 6% interest for 30 years. Your monthly mortgage payment is $1,439. Property taxes, $3,000 per year, $250 per month. Insurance, $100 per month. Maintenance, averaging $4,000 per year, $333 per month. Total monthly cost, $2,122. Now here's the key question. How much of that is building equity? First year, your mortgage payment breaks down like this. Principal, $395 per month. This builds equity. Interest, $1,044 per month. This disappears. So out of your total $2,122 monthly payment, only $395 is building equity. The other $1,727 vanishes. That's 81% of your payment disappearing every month. Is that really so different from renting? Now let's look at renting the same house. Rent for a $300,000 house might be around $1,800 to $2,000 per month. Let's say $2,000. You pay $2,000 per month. No property taxes, no insurance, no maintenance, no repairs. Landlord handles everything, but you're building zero equity. However, you also kept your $60,000 down payment. You can invest that. At an average 7% return in the stock market, that $60,000 grows. Year 1, $64,200. Year 5, $84,200. Year 10, $118,000. Meanwhile, the homeowner's equity after 10 years, assuming 3% annual appreciation, is about $110,000. The renter who invested the down payment has more wealth. This surprises people. How is this possible? Because homeownership has costs people don't account for. Let's go deeper into the math. There are 5 factors that determine whether buying or renting is better financially. Factor 1. How long you'll stay. If you're moving in 3 years, buying almost never makes sense. Here's why. When you sell a house, you pay realtor commissions, typically 6%. On a $300,000 house, that's $18,000. You also pay closing costs when you buy and when you sell, several $1,000s each time. In the first few years of a mortgage, you're paying mostly interest, building very little equity. If you add up the transaction costs and the low equity in early years, you need to own for at least 5 years, often 7 to 10 years, just to break even compared to renting. If you're not sure you'll stay at least 5 years, renting is usually better. Factor 2. Home price to rent ratio. This is the most important number most people ignore. Divide the home price by annual rent. If you can rent for $2,000 per month, That's $24,000 per year. If the house costs $300,000, the ratio is 12.5. Rule of thumb, below 15, buying might make sense. Above 20, renting usually makes more sense. 15 to 20. It depends on other factors. Why does this matter? Because it tells you if homes in your area are overpriced relative to rents. In some cities, home prices have gone crazy, but rents haven't increased as much. In those places, renting is often smarter. Factor 3. Expected appreciation. If home values increase significantly, buying looks better. If they stay flat or decrease, renting looks better. Here's the problem. Nobody knows future appreciation. You can look at history, but past performance doesn't guarantee future results. In most stable markets, homes appreciate about 3% per year long-term. But this varies wildly by location and time period. Some areas see 5 to 7%. Some areas see zero or negative returns for decades. If you're assuming big appreciation to justify buying, you're gambling. Factor 4. Your alternative investment return. When you rent, you can invest the money you would have spent on down payment, property taxes, maintenance, and the extra cost of owning versus renting. If you're disciplined and actually invest this money, and if you get decent returns, renting can build more wealth. If you're not disciplined and you just spend the extra money, buying forces you to save through equity. This is why buying works well for people who aren't good at saving. The forced savings through mortgage payments builds wealth, even if it's not the most efficient way. Factor 5. Interest rates. When mortgage rates are 3%, buying looks much better. When rates are 7%, renting looks much better. Higher interest rates mean more of your payment disappears as interest instead of building equity. Right now, in early 2026, rates are around 6 to 7%. At these rates, buying is less attractive than it was 5 years ago. Let's compare 3 scenarios over 10 years. Scenario 1, buying with good conditions, $300,000 house, 20% down, 5% mortgage rate. Home appreciates 4% per year. After 10 years, home value, $444,000. Mortgage balance, $173,000. Your equity, $271,000. Minus the $60,000 down payment you started with. Net wealth, $211,000. Scenario 2, renting and investing. Rent for $2,000 per month. Invest the $60,000 down payment. Invest the difference between total ownership costs and rent. That's about $122 per month extra. 7% average return on investments. After 10 years, your down payment grew to $118,000. Your monthly investments grew to $21,000. Total wealth, $139,000. In this scenario, buying created $72,000 more wealth. Scenario 3, buying with bad conditions. $300,000 house, 20% down, 7% mortgage rate. Home appreciates 2% per year. After 10 years, home value, $366,000. Mortgage balance, $200,000. Equity, $166,000. Minus $60,000 down. Net wealth, $106,000. Same renting scenario as before, $139,000. In this scenario, renting created $33,000 more wealth. See how much the specific numbers matter? Small changes in interest rates, appreciation, and investment returns completely change which option is better. So how do you decide for your situation? Ask these questions. Question 1. How long will I definitely stay here? Less than 5 years. Rent. 5 to 10 years. It depends. Over 10 years. Buying usually makes more sense. Question 2. What's the price-to-rent ratio in my area? Below 15, buying looks better. Above 20, renting looks better. 15 to 20. Run the numbers carefully. Question 3. Am I disciplined about investing? If yes, renting and investing might build more wealth. If no, buying forces you to save through equity. Question 4. What are current interest rates? Below 5%, buying looks better. Above 6%, renting looks better. Question 5. Do I value flexibility? If you might want to move for a job, relationship, or lifestyle change, renting gives you freedom. If you're settled and want stability, buying makes sense. Now let's talk about the non-financial factors, because buying versus renting isn't just about money. Factor 1. Control and customization. When you own, you can paint walls, renovate, landscape, do whatever you want. When you rent, you're limited. For some people, this freedom is worth paying more for ownership. Factor 2. Stability. Rent can increase significantly. Landlords can decide not to renew your lease. When you own with a fixed-rate mortgage, your payment is predictable for 30 years. This stability has value, even if it costs more. Factor 3. Psychological factors. Many people sleep better at night owning their home. They feel more secure. They feel like they're building something. This emotional benefit has real value. If buying gives you peace of mind, that's worth something, even if renting would build slightly more wealth on paper. Factor 4. Community and roots. Home ownership tends to create stronger community ties. You're more invested in the neighborhood. Your kids stay in the same school. You build deeper relationships. For many people, these social benefits outweigh financial calculations. Factor 5. Retirement planning. When you retire, having a paid-off house means lower living expenses. Your housing cost drops to just taxes, insurance, and maintenance. This makes retirement more affordable. Renters face rent payments forever. However, this assumes you stay in the house. Many retirees sell and move anyway, eliminating this advantage. Now let's address common myths. Myth 1. Renting is throwing money away. False. You're paying for housing. Homeowners also throw away money on interest, taxes, maintenance, and insurance. The question isn't whether you're throwing away money. The question is, which option costs less and builds more wealth? Myth 2. You need to own a home to build wealth. False. Plenty of wealthy people rent. They invest their money in businesses, stocks, or other assets instead of home equity. Home equity is one way to build wealth, not the only way. Myth 3. Buying is always cheaper than renting long-term. False. It depends on the price-to-rent ratio, appreciation, interest rates, and investment returns. In expensive cities with high price-to-rent ratios, renting is often cheaper even long-term. Myth 4. You're paying someone else's mortgage when you rent. True, but irrelevant. You're paying for housing service. The landlord takes the risks, handles maintenance, pays taxes and insurance. You're paying for convenience and flexibility. When you own, you're paying the bank interest. How is that different from paying a landlord? Myth 5. Home ownership is forced savings. Partially true. Yes, you build equity, but you're also paying interest, taxes, and maintenance. If you're disciplined, you can force save by automatically investing while renting. The real truth: home ownership forces savings for people who otherwise wouldn't save. Let me share 3 real examples. Example 1. Sarah, age 32, software engineer. Sarah lives in San Francisco. Average home price, $1.2 million. Average rent for similar place, $4,000 per month. Price to rent ratio, 25. Sarah runs the numbers. To buy would require $240,000 down. Mortgage payment at 7%, $6,500 per month. Plus taxes, insurance, maintenance, another $2,000. Total, $8,500 per month versus $4,000 rent. Difference, $4,500 per month. She invests this difference plus keeps her down payment invested. After 10 years, her investments are worth over $700,000. If she had bought, her equity would be around $400,000, but the house might have barely appreciated due to high starting prices. Sarah chose to rent. It was the right financial choice. Example 2. Marcus, age 41, teacher in Texas. Marcus lives in a mid-sized Texas city. Average home, $250,000. Rent for similar, $1,600 per month. Price to rent ratio, 13. Marcus can get a mortgage at 5.5%. His total ownership cost would be around $1,900 per month. Difference from renting, $300 per month. Homes in his area appreciate steadily at 4%. Marcus runs the numbers. After 10 years of owning, equity of $180,000. After 10 years of renting and investing the difference, about 70,000. Marcus chose to buy. It was the right financial choice. Example 3. Jennifer, age 28, consultant who travels. Jennifer knows she'll relocate every 2 to 3 years for her career. She loves the flexibility. Even though buying might make sense financially long-term, the transaction costs of buying and selling every few years would destroy any gains. Jennifer rents and invests aggressively. Her net worth at 38 is higher than most homeowner friends because she avoided transaction costs and invested consistently. Here's what I want you to do. First, calculate the price-to-rent ratio in your area. Find similar properties for sale and for rent. Divide purchase price by annual rent. Above 20, renting likely makes more financial sense. Below 15, buying likely makes more financial sense. Second, be honest about how long you'll stay. If there's any chance you'll move in under 5 years, renting is usually better. Third, run your specific numbers. Use an online rent versus buy calculator. Input your real numbers: down payment, interest rate, expected appreciation, property taxes, insurance, maintenance. See what comes out. Fourth, consider the non-financial factors: control, stability, community, lifestyle. These matter too. Fifth, make a decision based on your situation, not on cultural pressure or what people say you should do. The right answer depends on your numbers and your priorities. Here's my personal philosophy. Buying makes sense when you're staying at least 7 to 10 years. The price-to-rent ratio is reasonable. You value stability and control. You have a solid emergency fund and can afford the house comfortably. You're not stretching your budget to buy. Renting makes sense when you might move in under 5 years. The price-to-rent ratio is high. You value flexibility and lower stress. You're disciplined about investing the difference. Your career or life situation is uncertain. Neither is wrong. Both can build wealth. The key is making the choice that fits your situation, not following generic advice. One final point. You can change your mind later. You can rent now and buy later when your situation changes. You can buy now and sell later if you need flexibility. This isn't a permanent life decision. It's a decision based on your current situation. As your situation changes, your housing choice can change too. The worst reason to buy, because you feel like you should by a certain age. The worst reason to rent, because you're afraid of commitment or responsibility. Make the choice based on math and lifestyle fit, not on pressure or fear. Remember, wealthy people exist in both categories. There are wealthy homeowners and wealthy lifetime renters. The key to building wealth isn't whether you own or rent. It's whether you spend less than you earn and invest the difference. Housing is just one piece of your financial picture. Don't let this decision dominate your entire financial life. Buy if it makes sense. Rent if it makes sense. Either way, save money, invest consistently, avoid lifestyle inflation, and build multiple streams of income. That's how you build real wealth, regardless of where you live. Thank you for watching. If this video helped you think more clearly about buying versus renting, share it with someone trying to make this decision. Most people make this choice based on emotion or pressure, not on real math. You don't have to be one of them. Take care of yourself and your money.